Hi, everyone. Welcome back to So You Want to Buy a Home. Last episode, we talked about saving up for a down payment. If you haven't checked that episode out, it'll be linked down below. Um, this week, we're going to talk a little bit about just how to pick the right mortgage.
Not all loans are created equal. Depending on the loan you choose, it can save you thousands of dollars over time. So we're going to break down the pros and cons of different loan types, see which one might be best for you.
All right, well, let's get into it. So, what are the loan types?
The four primary loan types out there, you have conventional, which you can have as little as 3% down if you're a first time buyer. FHA is great. It only requires 3.5% down. It's also a little more lenient on credit requirements. So, for somebody who might have some credit issues they're rebounding from, it's a little more forgiving. VA is great if you qualify, if you're active duty or retired military. VA is 0% down. The interest rates are generally lower than what you're going to get with other loan types. And then if you're in a rural area, the USDA loans are really good. Um, Same thing. You can get in as little as 0% down, and the interest rates are usually pretty good on those.
So, if I qualify for VA or USDA, that means I don't have to put anything down at all.
In general, no. There are some circumstances with VA where you might have to put a little bit down, but in general, no, you don't have to put anything down. But even with the other loan types, like the whole, having to put 20% down thing that a lot of people think is needed is not the case. Like I said, with conventional, you can get in as little as 3% down if you're a first time buyer. Um, a first time buyer, aside from buying your first house, is also somebody who hasn't owned a home for 3 years. So even if you owned a home, but let's say you were a renter for a couple of years, you can still get in for as little as 3% down. So, yeah.
So, besides the type of loan, what else should I be thinking about?
Yeah, I think thinking about how long you're going to be in the home so you know whether or not you want to go with like a fixed rate or an adjustable rate mortgage. That is definitely one thing to consider. And then the other thing is, most people will do a 30-year term on their loan. But there's other options. Like there's a 15-year term where if you can make more payments on a monthly basis, by the time that mortgage is paid off, you're going to save a ton of money over the life of the loan. So I think those are probably two things I would also be considering as you're planning. Um, in general, I think for your first house, though, going with a fixed rate and just going with your traditional 30-year mortgage is going to
Okay.
be best.
So now that we've laid out the basics a little bit,
Mhm.
let's go into more depth about what you can expect in terms of differences between the fixed rate and an adjustable rate.
Yeah, well, fixed is just that. The rate you get at closing is the rate you're going to have throughout the life of the loan. So it doesn't matter if the market goes up or goes down. Your rate is your rate. With the adjustable rate mortgage, it will vary. You can get into a loan type where you have a fixed rate for a certain number of years. Then after that period of time, that interest rate might adjust. That could go up or down depending on where the market's at that point in time.
So basically, a fixed is it's more predictable, but adjusted rate might be cheaper at first.
Yeah, I think for a first time buyer, just going with a fixed rate is your smarter move. When the adjustable rate mortgages were created, they were really made more so for investors who are experienced with, buying and selling
Hmm.
property. I think the biggest thing with an adjustable rate mortgage, like where I would personally use one, would be, if I was buying a property, like right now, rates aren't super low. So if I was buying a property and I knew I was only going to have it for 2 years, and I could get a lower introductory rate, I would use that now, because in the first 2 years of owning a property with a loan, you're not really paying off a lot of principal. So I think the adjustable rate mortgage is going to give you a lower monthly payment. But again, you're going into it knowing, hey, I'm only going to have this for like 2 years. But if you don't know that going into the property, I think going with just a fixed rate, that way, if you are there for say 5 years, you don't wind up in year three with a rate that is unattractive and gives you a higher
Right.
monthly
Okay.
payment.
So now that we've discussed loan types, terms, interest rates, let's talk about monthly payments and what factors into those.
That's a good question. So your payment is broken up into four parts, and if I'm sure most people have heard PITI or maybe seen it, but it's principal, interest, taxes, and insurance. So your total monthly payment is going to be made up of those four components. So um, if you're ever online playing with a mortgage calculator, oftentimes they won't calculate one of those. So if you're ever playing around with payments, make sure you're factoring in all four of those categories.
And one more thing to add is if you're paying less than 20% down, you might have to pay private mortgage insurance.
Yeah, so depending on the loan type, there are, yes, there are, like, FHA, you do have additional payments that are going towards mortgage insurance. And but you do have some options. For instance, with a conventional loan, if you're putting down less than 20%, there are options where you can pay upfront to eliminate that mortgage insurance. So yes, that's true for anything under 20%, but there are also some options on certain loan types where you can buy out of that. That way, if you have a little extra money saved up front, you're eliminating that ongoing monthly payment.
So let's circle back to the four loan types we discussed at the beginning. There are probably some of you watching right now that are thinking to yourselves, well, what loan type is the right one for me? What should they do?
Yeah, so I would just look at it this way. With a conventional loan, I think that's going to be best for somebody who has pretty good credit and a good amount of money saved. That's definitely the loan type I would look at. FHA is going to be great if you're looking, if you have some credit challenges, you're kind of rebounding, but your credit's not quite where you need it to be yet to go conventional. FHA is great. It at least allows you, you get into the property, rates are still good, and you only need that 3.5% down. If you're a veteran, I would VA all day long. Historically, rates are generally better on VA loans than other options that are available to veterans. So you can still put money down if you want, but again, it's super nice because you don't have to put anything down. And if you are wanting to do like the mini farm or rural thing, agriculture, I would definitely look into the USDA loan for that. So I think those are like the four buyer profiles for each of those loan types.
Yeah, so basically, loan types aren't exactly a one size fits all. There are loan types that are, better for some people, worse for others, essentially.
Yeah, I think it just all depends on kind of where you're at in life, what kind of money you're looking to put down. But I think with any of those, regardless of what you're putting down or what loan type you're taking, I always think starting with, and we talked about budgeting, really figuring out what you're comfortable with monthly. And then as you're getting pre-qualified with the lender, really making sure that that lender is factoring in and showing you the principal, interest, taxes, and insurance. That way you understand everything you're paying monthly.
All right. Well, that about covers our topics for this episode.
Cool.
So our homework to you is, if you think you're possibly getting close to being ready to buy a home, our homework for you is to go talk to a lender and see what you qualify for.
Yep, which we can help you with. If you do need help, just send us a message. We'll get in touch with you and help put a plan together for you, figure out which loan is best for you.
All right. Well, that concludes this episode for the week. Hopefully you guys learned something. I know figuring out what mortgage type is best for you can be a little challenging. So I hope this video helped you guys out.
Yeah. And if we can clarify anything, please let us know. We talked about saving and budgeting and preparing to buy, but when you get to the point where you're actually choosing a loan, that's what is going to be connected to your ongoing payment monthly. So once you've done, the hard stuff, you've saved, you've gotten your credit where it needs to be, really take time to understand all of your options for lending, because that's the payment that you're going to be stuck with during the ownership of that property.
So comment down below, which loan type do you think is right for you? We'll talk about it. And be sure to tune in next week for episode 5. We're going to talk a little bit about house hunting, how to find the right home and avoid bad deals.
Sweet. That's the fun stuff.
Yeah.
Awesome.
All right. Well, make sure you like and subscribe. Thanks for watching.